Welcome to Turning Hard Times into Good Times. I am your host, Jay Taylor, and this is the 20th day of September 2016. I'd like to thank each of you for listening to this show. I'd like to also remind you that I am the author of a newsletter called Jay Taylor's Gold, Energy, and Tech Stocks. My company, Taylor Hard Money Advisors, is in partnership with Chen Lin, who publishes What is Chen Buying, What is Chen Selling. And Chen, actually, we want to congratulate Chen today for a home run that he just hit. He has been steadfastly recommending, pounding the table for Sarepta, this company, Sarepta Therapeutics. It traded as low as $8 this year. Today it was trading as high as $56 on the news that the company has gotten FDA approval for a drug that will save the lives of many young men that are destined to die by the age of 20 or so. Chen has passionately championed this drug, has worked very hard politically to try to do what he could to get it moving forward, and so we joyfully are thankful to Chen for his efforts, and very happy for the subscribers that have made money owning Sarepta. And those of you who would like to follow Chen and buy his newsletter, go to miningstocks.com to sign up for Chen's letter or my letter. And we certainly have had a number of very successful calls this year, too, with the gold price heading higher. I do want to thank our sponsors for making this show economically viable. Our sponsors for today's show: Coral Gold Resources, New Legacy Gold Corp, Novo Resources, Columbus Gold, Aran Resources, and Ariane Phosphate. Well, speaking of Ariane Phosphate, in a few minutes after our first commercial break, I will be talking to Brian Ostroff. He is the CEO and director of Ariane Phosphate. While most of our sponsors are gold or silver miners, I don't want to limit the opportunity to make money from other worthwhile industries as well. And for reasons that you will learn in a few minutes, Ariane Phosphate has the potential to not only play a role in feeding the world's population, but doing so in a much more environmentally friendly way than its competitors, most of its competitors at least, in the phosphate fertilizer business. The economics of the company's project in Quebec appear to be very robust, and shares of Ariane Phosphate appear to be massively undervalued. At least that's the way I see it. It is a company that I've covered in my newsletter. So I do hope that you'll stick around and listen to what Brian Ostroff has to say as soon as we come back from our first break. I'd like to point you to miningstocks.com, not only to subscribe to my newsletter and Chen's, but also to keep up with the companies that I'm following on in my newsletter, and our sponsors as well. For example, New Legacy Gold announced today that it had put out that it had a very good, solid intersection of gold intersection. You can read about that. Go to miningstocks.com, click on the link. Also, there is a link there that describes, it's actually a video that describes why Aran Resources, another sponsor of ours, why it is one of my favorite, actually my second largest holding, Aran Resources, a company I think people are going to make a lot of money in. Those who buy the shares now are likely to, as long as this gold bull market persists. And of course, we talked to you last week about Novo Resources, and Novo, there's some things there at miningstocks.com that I'd like you to follow up on as well. New Legacy will be with me next week, actually. James Anderson, who is with the company, will be here to talk about their exciting Iceberg project, which is displaying some very, very sizable gold intersections, which bode very well for the progress of that Carlin-style gold deposit in Nevada. And Aran Resources will also be with me very soon for an update as well. And also at miningstocks.com, I have a lot of, I think, very interesting articles. There are links to interesting articles under the section, Why Gold's Inevitable Rise to Thousands of Dollars. James Turk has an article there, The World is Headed for a Crisis, far greater than that of 2008. I think it's a very worthwhile read. Junk bond traders pile into bearish bets ahead of the Fed. And also another article, Housing Starts Tumble Despite Surging Homebuilder Confidence. Those are just a few of the articles you can read at miningstocks.com. Go there, click on the links, and away you go. We've titled today's show, What Happens to Gold When Stocks and Bonds Both Collapse? Alistair McLeod. Michael Oliver will be with me he's with me and we'll be talking to him just momentarily. And Brian Ostroff, as I said, will be with us after the first commercial break. Well, recently, over the past several months, there appears to have been at least somewhat of a breakdown in the relationship between U.S. equities and treasuries. It used to be that when the equity market went down, the bond market, the U.S. treasuries would go up, and vice versa. When money went into the equity markets, the bond markets would go down. Well, now we're seeing the treasuries, on many occasions, going down along with the equity markets. So why is this happening? This is one of the main topics we want to talk to. Alistair McLeod about. But for now, let's check in with Michael Oliver. Thanks for joining me again, Michael.
Hi, Jay. Good to be back.
Always good to have you with me. You know, I was probably over a year now or so, you've been warning about these great changes in plate tectonics, and you talked about how the S&P and the T-bond, the treasuries would both head down lower. That's what your technicals were telling you, your momentum structural analysis. Where do we stand now with that? And why do you think that might be taking place? I mean, can you think of a rational reason why both could go down at once? I know you're a technical guy and you like to focus on that and not try to let reason enter into what the markets may be doing, because none of us have enough knowledge to know for sure why markets are doing collectively, why markets are doing what they're doing. But first of all, where does the S&P and T-bond stand? And then perhaps if you can offer some rationale why they might both go down together.
Well, they've both been priced largely not by market forces but by central banks, even to the point of buying stocks. BOJ buys stocks, ETFs, and including outside of Japan. Swiss National Bank has been buying U.S. stocks. I mean, I think they own a lot of Apple, and so forth and so on.
Sure.
So they've got pricing mechanisms that are not free market forces. They're not voluntary exchanges. They're forced money goes into a market to put it where the central bank thinks it ought to be, as opposed to where the market says it ought to be. Why?
Mm-hmm.
Because they know better, of course. And
yes.
we're in that predicament. We've seen about 6 years of this now to the extreme. It's never been matched in global financial history in terms of the concerted effort by central banks across the developed world, especially developed markets, to price certain assets like debt markets, cost of money, and even equities at levels that aren't sustainable otherwise. So the question is, can they do it forever? And the answer, of course, is no, because they never succeed ultimately in any goal they pursue. And you can go back through history and find this is true. All the events that they create unwind at some point and create another boom-bust phase. They're the parents of the boom-bust cycle. Without them, I doubt we would have one. But we do have one, and we've got one that's excessive now. Both stocks and bonds are priced very high. Yields are very low, and there's technical evidence that it's shifting. I think they'll both go together, roughly speaking. I don't mean to say that there's been a notice lately on the financial channels that bonds and stocks tend to go together day by day. Don't expect that to continue necessarily day by day or even week by week. But in very broad strokes, I think that we are topping the debt markets. I'm talking the German Bunds, Japanese government bonds, the JGBs, and the U.S. 30-year Treasury, especially those three. And as they top and head down, yields will go up, and they will go up rapidly. And that should shock the heck out of the stock markets that will go with them. You got to remember, stock markets aren't just what we see in the U.S. on nightly news, S&P and the Dow. Those are highly unrepresentative of what stock assets in the developed world are doing. Look at the Nikkei 225 or the DAX, especially look at Italy. These stock markets are very sick. They're way off the highs of 2015. If we were at comparable levels, the S&P probably right now would be trading down around 1,700 or something, close to 2,100. So the S&P is not really a good representative sampling of, quote, stocks. It's a very narrow sampling. But I do think they'll move together. And simultaneously, as the good vibes that they have generated in the past few years for investors dissipate, and after all, think about it. In December of 2014, the S&P was trading just below 2,100 at a peak. We're trading just above 2,100. It's almost 2 years later, so it's not really a good feeling. And remember, that's just one of the strongest indices in the world. So the feeling, as the good feeling goes away, investors start to get nervous. They start to move elsewhere, and they're sophisticated enough now to recognize opportunities in commodities. Mm-hmm. Commodities as a class have been beat off the page from 2011 through the lows of 2015, or some of them are even making new lows, like hogs, for example. They're undervalued as a class, and it doesn't require a fundamental argument for an investor to begin to shift to commodity-related investments. They've done it before, so it's not a new thing for investors. They did it back between 2000 and 2011. They made a lot of money there. A lot of them made a lot of money in the late 70s. So it's not exactly something new and strange. And as the vibes get better and better in the commodity arena, for example, if you bought gold in January or bought the S&P in January, you're up slightly in the S&P. You're up vastly more in gold. So it's not just been a month or two or three. It's been 3/4 of a year of the vibes going in the direction of gold, silver, even oil's up more than the S&P this year. So
right,
it's
interesting.
It's an issue really of biofeedback.
Yeah.
And once that generates sufficient momentum, so to speak, the investors will flow that way because it works.
And it feeds on itself, yeah.
It feeds on itself.
Yeah, well, Michael, we're really basically out of time, but I want to say that you and I are old enough to remember 2000 and 2011 and the 1970s. You and I, yes, we're both old enough to remember those days. We were young men then, but certainly, those are times where you get rising interest rates and the gold price went higher too, right? So it can happen. But the young people that are behind their desks now for J.P. Morgan and Goldman Sachs and this, they've never seen this sort of thing. So it should be very interesting.
Yeah,
and they weren't taught in school because the gods of Wall Street know best, right? So anyway, they're about to be taught a lesson, I think, and markets have a way of humbling people. Richard Russell used to remind himself of that all the time. So. And I know you've been around long enough to know it as well, but your work has been remarkable. Michael, I want to thank you very much for being with us. And again, folks, it's Oliver MSA, olivermsa.com to learn more about
that is the correct site. It's under new construction, so a lot of it will not function. So when you go there, don't be disappointed if some of the buttons don't work. There's a major redo of the site, and also an increase in our rates, unfortunately, or fortunately for me. Anyway, the site is under construction and partly up.
Well, it's understandable if rates are going up because you've been very, very successful, and we thank you very much for sharing your insights to a certain extent, to a very limited extent, I might add, on this show, but nonetheless very much appreciated. Thank you very much, Michael, for being with us again, and I hope you can be with us again next week.